There's this quiet but absolutely massive shift happening in the world of finance. Way outside the walls of the big banks we all know, it's called private credit. And believe it or not, it's gone from this tiny niche thing to a major pillar of the entire global financial system. It's huge. Yeah, you heard that right. We're talking about a multi-trillion-dollar market that honestly most people have never even heard of. And it's completely changing the game, how money moves all around the world. So what exactly is it? And how on earth did it get so big so fast? All right, let's get into it.
All right, so here's how we're going to break it all down. We'll start with how this whole thing was born out of a crisis. Then we'll look at why companies love it, why investors are pouring money into it, and then we'll get to the risky part, what some people are calling shadow banking. And finally, we'll talk about what this means for the future. Let's go. Okay, so to really get a handle on private credit, we've got to rewind the clock. Let's go back to a moment that pretty much changed everything, the 2008 global financial crisis. Now, this wasn't just another market crash. Nope, it was more like the starting gun for a totally new way of doing business in finance.
So after everything went sideways in 2008, regulators, for very good reason, came in and slapped all these heavy new rules on banks. They wanted to prevent another meltdown. But this had a massive side effect. Banks got super cautious. It became way harder for them to lend money, especially to medium-sized or more complicated businesses. And just like that, you had this huge lending vacuum, and a brand new kind of player just rushed right in to fill that gap. So here's the key difference, right? On one hand, you've got your traditional banks. They take our deposits, your savings account, my checking account, and they lend that money out. But they have to follow a ton of strict rules. Now, on the other hand, you've got these private credit funds. They don't take public deposits. Instead, they raise massive pools of capital directly from big institutional investors. We're talking pension funds, insurance companies, the heavy hitters. And then they lend that money directly to companies. And because they're not a bank, they can be way, way faster and a lot more flexible. Okay, so let's switch gears and look at this from the borrower side, a company that needs cash. Now, you might be wondering, why on earth would a company go to one of these funds and probably pay higher interest rates instead of just walking into a regular bank? It's a great question. Well, for these companies, it really boils down to three huge advantages. First up, speed. We're talking about getting funding in a matter of weeks, not the months and months it can take to go through a bank. Second is flexibility. These private funds can create totally custom-made loans, bespoke deals that are tailored exactly to a company's unique business model. And third, and this is a big one, privacy. They can get the money without having to broadcast all their strategic plans to the public, and more importantly, to their competitors. And look, this isn't just some abstract financial stuff happening on Wall Street. We are talking about major real-world impact here. Private credit has basically become the engine that's funding these massive, essential infrastructure projects for our future. Think about it. The data centers that power our internet, the huge renewable energy farms, all the digital networks we rely on, a lot of that is being built with this money, especially when governments are on a tight budget. And the scale here, it's just staggering. Projections are showing that private credit is on track to finance 40%, 40% of all new infrastructure projects. So this thing has clearly moved way beyond being just another financial tool. It is now a primary driver of the actual physical economy. All right, so we get why companies are lining up for these loans. But what about the other side of the coin? Why are these giant investors, pension funds, remember? Why are they pouring literally trillions of dollars into this market? Well, it all comes down to what they call the hunt for yield. They're desperately searching for good returns in a world where interest rates have been low and stocks can be all over the place. And for these investors, private credit has two, killer features. First, the loans usually have floating interest rates. What does that mean? It means when central banks raise interest rates to fight inflation, the returns on these loans actually go up too. It's a fantastic hedge. And second, the loans are often senior secured. Now, that's just a fancy way of saying that if the company they loaned money to gets into trouble, they are first in line to get paid back. So you can see the appeal, right? It's this compelling mix of potentially higher returns with some pretty solid downside protection. But of course, with every massive boom, there's always a shadow lurking somewhere. And a market that's this big, growing this fast, and, critically, operating outside of the normal oversight, that raises some very, very serious questions about risk. I mean, what could possibly go wrong? And look, this isn't just some spooky name we made up. The people in charge, financial regulators, they officially call this world shadow banking. And that label tells you everything you need to know about their concern. It's about a massive piece of the financial system that they just can't fully see into or control. So what are the actual dangers here? Well, the number one issue is a total lack of transparency. It's incredibly hard for anyone on the outside to know the true value of these loans or how much risk is really being taken on.
And unlike banks, these funds don't have to keep a bunch of cash on the side, reserve requirements, to cover losses. So the nightmare scenario, the thing that keeps regulators up at night, is a big economic downturn. A wave of companies can't pay back their loans, and that could trigger a chain reaction liquidity crisis. Basically, a domino effect that could rip through the system because nobody really knows who is exposed to whom.
And this, of course, brings us to the multi-trillion-dollar question. If the global economy really does hit a wall, what happens? What happens to a system that is this big, this interconnected, but exists almost entirely in the shadows, just out of sight of the very regulators whose job it is to prevent a financial collapse? But despite all those risks, one thing is becoming crystal clear. Private credit is not just some passing fad. It's cementing its place as a permanent, powerful feature of our financial world. So where does it go from here? Let's take a look at how this market is evolving and what that really means for the future.
Okay, one of the biggest changes happening right now is a trend called retailization. Now, this market used to be the exclusive playground for those giant institutions we talked about, but now it's being opened up to wealthy individuals. And while that brings a ton more money into the system, it also means the risk is being spread out much more widely into a lot more hands.
And if you want the ultimate proof that this is the new reality, just look at the banks themselves. They're jumping in with both feet. Instead of trying to fight it, all the major banks are now launching their own private credit departments or partnering up with the big funds. It's a classic case of, if you can't beat them, join them.
And so, all of this leaves us with one final and really crucial question. For decades, it was pretty clear who was in charge of the money. The big, regulated banks. We knew their names. But now as the lines between traditional banking and this new world of private credit get blurrier and blurrier every day, you have to stop and ask, who is really in control of the global flow of capital now?